everyone, I'm Jun, a researcher with The Expert. Hey, earnings season is back. In this episode, we are diving into how the major players in the US banking scene like JP Morgan, Wells Fargo, Bank of America, Citigroup, and others are performing. After that, we will shift gears to discuss what lies ahead and explore the potential opportunities in the banking sector for 2024. Now, banks serve as the backbone of the economy, providing crucial liquidity for everyone, from household to big operations. That's why taking a close look at the banking sector is vital. And if you are into trading majors US indices like the S&P 500 and US 30, not to mention individual banking stocks, then pay attention. It could offer insights into what's on the horizon. Let's get started. JP Morgan is still basking in the advantage of being an industry giant. Their triumph in acquiring the failed First Republic through an auction significantly contributed to their positive result this year, showcasing overall strength with increased revenue and profits, making it a record-setting year for the bank. Breaking down the financial figures, JP Morgan reported earnings per share of $3.04, slightly falling short of the expected $3.32. Revenue came in at $39.94 billion, surpassing the anticipated $39.78 billion. Despite a 15% slip in the quarterly earnings to $9.31 billion. Now, if we exclude the fees tied to the regional bank crisis and $743 million in investment losses, earnings would have been $3.97 per share, according to JP Morgan. Now, JP Morgan CEO Jamie Dimon attributed the record-breaking full-year results to outperforming expectations in net interest income and credit quality. The bank reported nearly $50 billion in profit for 2023, with $4.1 billion coming from the acquisition of First Republic. In contrast, Wells Fargo celebrated a 9% increase in fourth quarter profits, bringing in some positive news. However, Bank of America faced a setback, experiencing a 56% drop in quarterly profits compared to the previous year. Bank of America reported $29.96 billion in revenue for the quarter ended December 2023, reflecting a year-over-year decline of 10.5%. The fourth quarter unfolded differently, witnessing a decline in profits at JP Morgan and Bank of America, primarily due to the one-time charge related to the failed banks. All major players were impacted by an FDIC special charges, causing significant financial effects, especially for Wells Fargo and Citigroup. Citigroup faced unexpected challenges, resulting in a quarterly loss that surprises investors. In response, the bank implemented significant measures, including cutting 20,000 jobs and undergoing a restructuring process. Consumers keep spending. Credit card spending is up, but the catch is credit card loans are up too. So people are spending on their credit cards and not paying it off as much every month. It's growing, so banks are putting aside more money because people aren't paying off their credit cards loan as much. Essentially, the executives say, look, right now, the consumers are strong and they point a lot to the labor market. But the executives are worried as well that those pandemic bank accounts have drawn down. People don't have as much money hanging around anymore. They are spending more because inflation is up. The economy is good, but people are worried about it and no one's quite sure what's coming. So, I think it's the same pictures from banks. Things right now are stronger than anyone expected them to be. It is unclear that it's going to continue. Shifting our focus to Morgan Stanley, the overall profit experienced a 32% decline compared to the previous year, settling at $1.5 billion or 85 cents per share. However, the revenue story painted a more optimistic picture, reaching $12.9 billion, a 1% increase from the previous year and surpassing analyst expectations of $12.77 billion. Delving into specific segments, the investment banking revenue saw a 5% uptick from the previous year, reaching $1.32 billion. Trading stocks and bonds contributed to the positive narrative with a modest 1% increase. The wealth management unit, a substantial contributor, generated $6.65 billion in revenue, maintaining stability compared to the previous year and constituting approximately 49% of the total company's revenue for the year. In the legal realm, Morgan Stanley settled for $249 million in the preceding week to resolve criminal and regulatory investigations. These investigations centered on allegations of improper sharing of information about clients' stock sales by some employees, bringing an end to a prolonged probe into the banks of large blocks of stock for institutional investors. Morgan Stanley also faced a special assessment by the FDIC, resulted in a $286 million charge for Morgan Stanley. Navigating through challenges in its final quarter under government's leadership, the banks aim to resolve key issues before the new CEO, Ted Pick, assumed the role. This latest earnings report marks the conclusion of James Gorman's 14-year tenure as chief executive, with Gorman stepping down this month and Ted Pick taking over the reins. Moving on to Goldman Sachs, the bank delivered an impressive fourth quarter earnings report, driven largely by outstanding performance in their asset and wealth management division. The company reported a robust 51% increase in profit from the previous year, surpassing $2 billion. Goldman Sachs disclosed revenue of $11.3 billion and earnings per share stood at $5.48, exceeding Wall Street's predictions. Analysts surveyed by FactSet had anticipated revenue of around $10.8 billion and earnings per share of $3.62. Interestingly, the majority of Goldman's gain didn't originated from their traditional stronghold, investment banking and trading. Revenue from investment banking experienced a 12% dip from the previous year, reaching just under $1.7 billion. Similarly, trading revenue decreased by 2.5% to $4.6 billion over the same period. Under the leadership of CEO David Solomon, Goldman Sachs strategically shifted its focus to simplify its strategy and invest in the assets and wealth management division, closely tied to stock market performance. This strategic pivot paid off, evident in a remarkable 23% increase in revenue within that division, outshining the declines in investment banking and trading revenues. Despite Goldman's previous retreat from its ambitious plan to offer loans on a broader scale, the bank reported a very solid quarter. Curt Furman, the Chief Investment Officer of select US equities portfolios at AllianceBernstein, and also a Goldman shareholder, emphasized the market's optimism for Goldman Sachs' 2024 prospects. While acknowledging the challenges for Goldman to sustain this success, Michael Farr, the Chief Market Strategist at Hightower Advisors, who is also a holder of Goldman shares, supported the bank's exit from consumer lending. He praised Goldman's return to core business, emphasizing the importance of owning and highlighting its nimbleness and dynamism in the market. The spotlight on regional bank earnings began with PNC Financial Services Group, but unfortunately, the results weren't all shine and rainbows. PNC reported a significant 43% drop in net income from the previous year, landing at $883 million in the fourth quarter. This translated to $1.85 per share, falling short of the $2.12 forecasted by analysts hoped by FactSet. Revenue also took a hit, sliding 7% to $5.4 billion, although it slightly surpasses the expected $5.3 billion. The financial stumble can be attributed to a $515 million charge earmarked to replenish a FDIC fund. Adding to the challenges, PNC reported $115 million in workforce reduction charges, in line with their previous announcement of layoff impacting thousands of employees. On the lending front, PNC faced an uptick in problematic loans, particularly in the commercial real estate sectors. Net charge-off in this area surged to $54 million, more than doubling from the previous year. Well, it seems like the final stretch of the year brought some unexpected challenges to this banking giant. Setting aside one-time fines and payments, it's apparent that most banks are thriving, prompting questions about whether this success in the banking sector is a reflection of a robust and sustainable economy. Consumers are actively participating in spending, notably increasing their use of credit cards. However, a significant concern arises as credit card loans are on the rise, indicating that individuals are accumulating balances on their credit cards and not consistently paying off each month. In response, banks are cautiously setting aside more funds in anticipation of the growing numbers of outstanding credit card loans. Industry leaders acknowledge that as well. At present, consumers seem financially robust, often citing positive indicators from the labor market. However, an underlying worry among this executive revolves around the depletion of savings accounts established during the pandemic. Individuals appear to have less disposable income and their spending is influenced by persistently high inflation. The current economic landscape is a nuanced blend of strength and uncertainty. In the fourth quarter, the largest US bank generally fortified reserve with card loan growth and normalizing credit being key drivers. Bank of America's reserve release was an exception, specifically a reduction in commercial provisions offset by an increase in card provisions, fueled by an improved economic outlook. Charge-offs were slightly higher than expected for all but Morgan Stanley. Weakening commercial real estate contributes to increased charge-off, particularly with office fundamentals weakening. Provisions are expected to rise at the four largest lenders in 2024. The major card lenders provided guidance for higher net charge-off rates. Citigroup forecasts a net charge-off rate of 3.5 to 4% in 2024, after a 3.06% ratio in the fourth quarter for its branded card business, with a projection of 5.75 to 6.25% for retail services, up from 5.44% in the fourth quarter. JP Morgan expects a rate of less than 3.5% for 2024, up from 2.8% in the fourth quarter. In the recent years, the largest US lenders enjoyed revenue growth, primarily fueled by net interest income, or NII, expansion. However, the outlook for 2024 appears less favorable for core NII, considering market-implied rates and subdued loan expectations, including card-related activities. During the fourth quarter, net interest income at the four largest US lenders and Morgan Stanley's wealth unit either met or surpasses consensus expectations. Notably, net interest margins generally contracted, with JP Morgan being a notable exception as it experienced an expansion from the acquisition. Examining specific banks, Wells Fargo's guidance anticipates a 7 to 9% decline in net interest income, assuming a 4.6% drop from the fourth quarter's base, with a trough expected towards year-end. The bank envisioned slight reductions in average loan balances with modest growth in the commercial and card sector in the second half. Consumer deposits are expected to decline, leading to a higher proportion of interest-bearing deposits. Bank of America outlines a trajectory of continued quarterly revenue declines in the first half, following by growth in the second half. This assumption incorporates expectations of low to mid-single-digit loan expansions and moderate increase in deposits. JP Morgan's core projection of a 2% drop assumes slightly lower deposits, with less repricing pressures and muted loans outside of robust but slower card growth. In the backdrop of the fourth quarter results released on January 12, futures prices for Fed Fund implied approximately 6 rate cuts in 2024. The market implied rate stood at 3.65% in mid-December, a decline from 4.64% when the third quarter reports were disclosed on October 2023. JP Morgan, Wells Fargo, and Bank of America each factored in the expectations of 6 rate cuts in their NII projections. In contrast, Citigroup, being globally exposed and sensitive to non-US rates, factored in 3 to 6 cuts, assuming modest declines outside of the US. The evolving interest rates scenario is a key factor influencing the NII outlook for these banks in 2024. The resilience of consumers is uncertain, and we can only wait to see how it unfolds. However, there are discernible trends that offers insight into the banking sector's potential trajectory in 2024. Among the major US lenders, a cautious approach is warranted due to a shifting interest rate landscape and considerable uncertainty. Elevated costs persist due to ongoing investments, although efficiency remains a primary focus. Credit concerns, particularly in card and commercial real estates, continue to be the focal point. Interestingly, Citigroup and Goldman Sachs deviated from the general trend, eliciting positive reactions. Their narrow business focus and advancements in cost management were well received. Citigroup's substantial restructuring, coupled with anticipated job cuts, is expected to enhance savings. In the context of these challenges, what factors might support the stability of US bank shares? 3 key themes emerge: trading performance, investment banking fees, and compensation costs. These aspects will likely play a pivotal role in influencing the resilience and performance of US banks' shares during the year. Global fixed income, currency and commodities (FICC) and equities trading remain constantly high, operating within historical ranges. There's an expectation of a rebound in investment banking fees in 2024 if US interest rates are indeed undergoing an inflection point. As anticipated by the market, the confluence of CEO confidence and financing cost dynamics could potentially drive growth in underwriting and advisory businesses. However, in the last quarter, trading and banking fees at Goldman Sachs, JP Morgan, Bank of America, and Citigroup fell below expectations, with only Morgan Stanley showing a positive result. Across the banking sector, there is an anticipation that equities may outperform FICC on a year-over-year basis, and underwriting fees are expected to outperform advisory fees, partially due to more challenging year-ago comparison for issuance. Institutional performance saw positive outcomes from leading equities and mergers and acquisitions revenue, surpassing estimates. M&A fees experienced a notable 21% growth from third quarter 2023, driven by backlog replenishment, and overall trading and fees demonstrated resilience compared to the fourth quarter of 2022. JP Morgan is optimistic about a resilient outlook for trading and fee potential in the first quarter. Thanks for joining me today. Remember that not all banks are the same, so picking one that aligns with the key themes could open up opportunities. Everything I've shared are informations that I've picked up and learned, sprinkled with a bit of my takes on things. When it comes to trading or investing, do your own due diligence and be mindful of the risk. If you find this video helpful for your research, don't forget to share it with your friends as well. They might find it useful too. Quickly access to all our channels by scanning the QR code, and take care, and I'll see you in the next episode.